Good afternoon to everybody who's out there. It looks as though we have people starting to join. We'll start in a minute or two here. It is just 12 o'clock, so I'll just give it one more minute to let people get on and get their computer started and they're being able to hear me. All right, we'll get moving. It looks like a few more people might be jumping on, but they'll join us when they join us, right? So thank you for joining me this afternoon. Again, I'm Janice Kakowski, Century Financial Advisors, and here today to talk to you a little bit about the American tax system, and so you can understand a little bit about that. Housekeeping. You can see me, I cannot see you. So if you're home in your jammies, more power to you. I'm a little bit jealous on this rainy, crummy day. So there is a question and answer box that you can type questions in if you have questions along the way. I have another screen behind my camera that I can see the questions come up. If I can answer along the way, I will. If there are questions that I cannot answer, I will get back to you. And I'll definitely reach out and let you know. I don't know everything. So I believe that's it as far as housekeeping is concerned. So let's get started. We're going to talk today. Oh, again, I didn't say thank you for your patience with me about the rescheduling of this event. You can see it was supposed to be on April 15th on tax day, but my son decided to get in a baseball accident. So life happens, but he's good, he's healing, and I'm back at work. So that's all good. So again, thank you. I want to make sure I'm recording and let's get that going. Okay. So thank you much again. Let's get going. Understanding the U.S. tax system. All right. Do you know how the American tax system works? A lot of people don't. Understanding tax and explaining tax on the basic level is very easy to understand. The government takes a portion of our income as tax, and that tax collected is used to pay for everything the government does for us, for building roads and infrastructure and police and fire services and things like that. So it sounds simple, right? What we need to understand is really, as taxpayers, it's good to understand how that system works. If you don't understand the basics of it, you won't know how to best utilize tax credits that are out there or new tax laws that we have seen over and over again these past couple of years. So we'll talk a little bit about that. You do not need to be a tax expert. You have experts that you can lean on as far as a CPA, financial advisors, people that can help you when things get complicated. But to understand the basics is a good thing. So let's start talking about the progressive tax system. Our income tax, talking about the federal income tax system, is what's called a progressive tax. And that means that those who make more money pay a higher tax rate, right? In theory, at least that's what it means. Okay. All money that you make during the year is considered income as far as wages and lottery winnings, if you're so lucky, any Social Security income that you're collecting, any interest, dividends, things like that. Okay. There's one exception to things that are something called income. If you earn capital gains, that is not considered income as far as tax is concerned. It's taxed a little bit differently. Okay. Capital gains is if you were to buy a stock or a bond or a mutual fund, whatever it is, outside of an IRA type of account. Anything that you gain on that stock, let's say you buy it for $100, you sell it for 150, that $50 difference is your capital gain, and you have to pay what's called capital gain tax on that $50. You don't pay income tax, you pay what's called capital gains tax. Okay. So let's talk a little bit about capital gains. If you took $1,000 and you successfully gambled that in a casino and you walked out with 100 grand, okay, you have to pay income tax on that $99,000 winning. Good for you for winning that, but now you got to pay tax to Uncle Sam on it. If you take that same $1,000 and you invest it in the stock market and you earn 99,000, so you sell the stock for 100 grand, you earn 99,000. That's not considered income, it's considered capital gains. So winning the money in Vegas means you have to pay normal income tax on it, but winning money on Wall Street means that you sometimes have to pay only about half the tax on it with capital gains. So if you work for a wage and you take the money that you earn, of course, you buy something else, now you have to pay sales tax on it and purchase things like that. So there's taxes all over the place. There's ways that you can reduce the amount of tax that you pay on the income that you earn. There's mortgage interest. You can take a deduction for mortgage interest. Charitable gifts, possibly. The standard deduction that all of us get, whether we can itemize our deductions or not. To be able to get a deduction for mortgage interest, charitable gifts, and things like that, you need to have deductions that exceed the standard deduction for each year. The standard deduction has gone up quite a bit recently, so most people are taking standard deduction. I'm going to pull up this Numbers Unlimited chart, which is one of my favorite charts. A company called Financial Plan Incorporated puts this out every year. And this is one of these things that I have laminated on my desk and in my briefcase, and it goes with me everywhere because it's a great cheat sheet. Okay, so I'm going to scroll down just a little bit here in the very center, and you can see standard deduction. Okay, for a married filing jointly couple this year for 2021, the standard deduction is $25,100. So if you don't have deductions of mortgage interest and real estate taxes and charitable deductions that are more than $25,100, then you will just use the standard deduction. Okay, this little cheat sheet I did send out to everybody. Hopefully you have it. It really is a good thing to have. So again, I got a little ahead of myself before. If you work for a wage and you take money that you earn, you go out and you buy and you shop, you have to pay sales tax on that. Okay, this tax varies depending on where you buy it, what you bought. People who buy and sell pieces of companies or stocks, okay, they don't have to pay a tax on that purchase, but you have to pay tax on when you go out and buy a car or when you go out and buy clothing, you have to pay tax on that. So stocks are a little bit different. When you buy that, there is no sales tax. Companies are taxed too, of course, but they're not taxed on their income. They're only taxed on their profits. Many business expenses, you can hear that a company can write off things. And I get comments like that all the time. Well, why don't you just write that off through your business? Well, it doesn't mean I don't have to pay for it. It just means that I now may not have to pay tax on certain expenses. But large businesses can really take advantage of that, the certain kind of deductions that they have. Some corporations that may make millions of dollars in profits can make that profit practically disappear. And I'm going to pick on Amazon a little bit because they've been in the news in the past about this specific situation. So in 2018, Amazon posted income of more than $11 billion, but the company paid zero in federal income tax that year. They did that because of all these expenses that they were able to write off, and they were able to bring that profit down as far as taxability, down to a point where they didn't pay any tax. In fact, in that same year, Thanks to tax credits, Amazon received a federal tax refund of 129 million bucks. So that makes people cringe a little bit. That was a year after Amazon received $137 million refund in 2017. So, however, in 2019, Amazon was on the hook to pay a $162 million tax bill. Does that make you feel a little bit better? Well, they had a $13.9 billion of income that year. And if you do the math, Amazon paid a 1.2% federal tax in 2019. So again, makes the skin crawl a little bit when you see what you pay on your tax return and do the calculation and figure out what percentage of your income you paid in tax. Guaranteed it was probably more than 1.2%. So tax laws are written by Congress. We know that. That's the legislative branch of our government. The people in Congress get elected by the citizens, right? To get elected to Congress, it costs a lot of money because campaigning isn't cheap. So the money raised by people running for Congress comes from lobbyists. Those lobbyists are basically people who bribe the members of the Congress with campaign funds, but we don't call it bribing, right? We don't want to talk about it like that because it sounds a little dirty, it sounds unethical. But when we get down to it, that's pretty much what it is. The lobbyists go to the people running for Congress. You know, if you get in and you vote this specific way, I'm going to give you a whole bunch of money to run. Okay, so these tax laws, let me go back up a little bit. So say you're a company that builds widgets, right? You join on with other widget makers and form a business group. You pay all the money to this group, and the group takes that money and gives it to lobbyists. The lobbyists then find the Congress people to try to bribe, quote unquote. And then when tax laws are drawn up, those politicians, which you've supported financially, maybe write into the tax code that the widget makers don't have to pay tax on X, Y, and Z. So that's how that goes. The more money that you have to give to politicians and to support politicians, the better tax breaks these big companies can get. So that's how a lot of these big companies get, or maybe not companies, but organizations and manufacturers and whatnot. It's kind of how they get these tax breaks. So not a very fair system when you think about it that way. I certainly can't go to my congressman and bribe him to get my personal Kakowski household taxes reduced. Okay. So the progressive income tax system, we'll talk a little bit more about that. I'm going to give an example, but the Social Security system is actually a regressive tax. The more money you make, the less you pay into the Social Security system, not less dollar amount, but less of a percentage of your income. Okay. Those who make very little money, or normal people, I should say, have to pay 6.2% of their full income into the Social Security system. In 2021, people who make more than $142,800 do not pay that 6.2% Social Security tax on any of the income they earn above and beyond that $142,800. All right. So we got LeBron James earning who knows what, and he's only paying 6.2% into the Social Security system on his $142,000 income. Anything above and beyond that, he's not paying into the Social Security system. Okay. So people making millions of dollars a year, they're paying a very tiny fraction of their salary into the Social Security system. All right. So let's do just a quick review of what we've talked about. We have a progressive tax system so that those people who make the most money pay the highest percent in tax, except for those who make most of their money buying and selling stocks. They pay only about half of the percentage that everyone else pays as far as income. Everyone pays sales tax except those buying and selling stocks. They don't pay sales tax. Those people pay tax only on the transaction. Businesses are taxed differently than people, and they're allowed only to pay tax on their profits, not on their income. Businesses are also allowed to report profits to their stockholders, but then They report a different number entirely to the government when they fill out their taxes. Sometimes very large corporations pay absolutely no tax at all, as we just talked about in our example. And if they don't like the tax laws, wealthy people in large businesses are allowed to bribe the taxpayers to create loopholes in the law. So I'm saying all this and a little bit of tongue in cheek, but it's really complicated and there's a lot going on. Okay, so I talk about that the progressive tax system doesn't sound like a very fair system, does it? So let's move on a little bit and let's talk about an example. So we have Lucy and Desi, and depending on your age of the people on this call, whether you know who they are a married filing jointly couple earning $120,000 a year. So if you look at that Numbers Unlimited handout, if you happen to have that, okay, Lucy and Desi are going to pay up here, this whole top section I'm going to talk about, and we're looking at the married filing jointly column. This shows that Lucy and Desi are going to pay 10% tax on the first $19,900 that they made during the year. They're going to pay 12% federal tax on the next $60,000 when you take the difference of those two numbers, and so on. That's how this chart works. Okay. So going on, they're going to pay an additional 22% tax on the remaining $38,000. So all those numbers add up to $120,000 as far as income. Their total federal tax is going to be $17,897,000, right? Simple, but not so fast. It's not that simple. They have a standard deduction that they can use to reduce their taxable income of $25,100. I'm assuming that they're both under age 65, because if you're over age 65, you get a little bump in that standard deduction. So Lucy and Desi are going to pay tax on only $94,900 rather than on their full income of $120,000, because we reduce their $120,000 by $25,100 and they pay the tax on the difference. Or they can itemize their deductions if their deductions are larger than that $25,100. But for our example today, we're going to talk about standard deduction. So that's it, right? No, that's not it. What if Desi contributed $7,000 into his traditional IRA for the year? They will also get that amount deducted off their taxable income. What if Lucy contributed $8,000 to her 401k plan at her company? They also deduct that from their income. They don't have to pay tax on those two things in this year. What if they contributed $600 to the American Cancer Society? That donation in 2021 only, okay, can be deducted as an above the line deduction on their 1040. This is a tax code change that was for last year and this year, 2021. Even if you don't itemize your taxes, you can make a cash donation as a single person up to $300 to a qualified charity, and you can deduct it off of your income. If you're a married filing jointly couple, you can give a cash donation of up to $600. And when I say cash, I don't mean you got to walk in with $600 bills. You can write a check. It just can't be goods. It needs to be money. Okay. So thanks to the American Rescue Plan Act for that, they get an extra $600 taken off of their income, and they don't have to pay tax on that this year either. All right, are we done? Not necessarily. What if Lucy and Desi have two children, age 14 and 15? They get a child tax credit applied against their income of $3,000 per child. Okay, that tax credit directly reduces the tax owed. So Lucy and Desi, let's look at their final tax. And this is a very, very basic example, okay? But after taking all of this into consideration, their taxable income went down from $120,000 down to $79,300. So they will be taxed as follows. They'll be taxed 10% on the first $19,900. Remember your chart. Okay, they'll be taxed 12% on the next $59,400. So their total tax is about $9,118. We're going to subtract the $6,000 child tax credit. Their final tax is $3,118. Again, only federal income tax. So let's go up a little bit. When we first started, tax example, the very first, we thought just taking their income into consideration and nothing else, that they were going to pay 17 grand in tax. But that's not the case. There's a lot of things that can happen in life and deductions that you can take in order to affect what taxes you pay that can positively impact. Okay. So the moral of the story is the tax code is confusing. It's very difficult for the everyday person to understand and manipulate. And I say manipulate, meaning how do you understand what you can do on a day-to-day basis that affects positively your tax bill? Okay. Not every person is going to want to take a taxable deduction today. They may want to do something a little bit different to set themselves up better for down the road for in retirement and give themselves more tax-free dollars in retirement. But it depends. It depends on your situation and what you're going through today and what you're trying to set yourself up to do in the future. Okay. But it is difficult. There's a lot of stuff going on within the tax codes. And the last 2 years, we've had crazy tax law changes, things that have been very good for some of my clients. And it's been terrific to be able to use those. But unless you understand it, understand number one, how do you pay tax in your family situation? And what about those tax codes and how can you use them to your benefit? Each person and family is unique to another at how they're taxed. So don't take advice from your neighbor or from your brother-in-law. Everybody always says, I got a brother-in-law that does this, right? Well, unless he's a CPA or your neighbor's a CPA or a tax attorney or a certified financial planner, don't take advice from them, okay? Talk to somebody who can understand your situation and give you the best advice for you. The new tax laws I have that we talked about last week, it was something that we talked about a while ago, can give really good opportunities to some people to save on their taxes. We talked a little bit about that small charitable deduction, but there were some big things that happened in the past and things that are happening this year still that some of my clients and some individuals can really benefit on their personal taxes. And using the tax system to your benefit is important at all times, but especially last year in 2020 and this year in 2021, when Congress did afford us a few more ways to save. All right, we were quick and brief. Usually I stay to 30 minutes and I'm done in 22 minutes. So that's pretty good. Any questions? I don't see anything up on the screen, but I'd love to be able to answer your questions. If you don't want to shout out questions today, feel free to send me over an email. You know how to reach me. Our next session, I don't even know what it is. I don't have my list in front of me. I usually have it to tell you what my next session is going to be in May. But if you've got the invitation for this one, you will receive it for next month. I hope this gave you a little bit of impact about what your own personal taxes are like. I hope that the chart that I sent over as far as this Numbers Unlimited, this is something that is really cool. When I work with clients, I kind of walk through this thing with them so that they understand how they're being taxed. And I do some tax projections. I do not file tax returns. It's not who I am. I just do financial planning and tax planning. But again, more than happy to answer your questions for your specific situation. Thank you so much for taking your time with me today. Again, you'll get a invitation for next month. I do these webinars, 30-minute webinars once a month. Take care. Talk to you soon. Bye-bye.